Alphabet, Google's parent company, announced a 20-for-1 stock split in its quarterly results announcement on February 1st. It's just the stock's second split since it went public in 2004. Issuing 19 extra shares for every share owned would reduce Alphabet's stock price from $2,700 per share to less than $150 based on today's closing price. On the news February 2nd, the shares jumped more than 8%, approaching $3,000. The 20-for-1 split outperforms recent stock splits from Apple and Tesla, which divided 4-for-1 and 5-for-1 on the same day in August 2020, respectively. NVIDIA, another popular tech stock among ordinary investors, will split 4-to-1 in July 2021. Will Tesla announce a stock split soon? Keep watching to find out more. Stock splits reduce the price of a stock, in Alphabet's instance to 1/20th of its original price, potentially making it more appealing to individual investors. Wall Street has seen a tremendous surge of retail traders since the commencement of the COVID-19 pandemic. Simultaneously, tech stocks such as Alphabet, Apple, Tesla, and NVIDIA have all skyrocketed, fueled by low interest rates and increased demand for their products. Since March 2020, the price of Alphabet shares has more than doubled. Massive stock split ratios such as Alphabet's are uncommon, but not unheard of. Getty Oil planned a 20-for-1 stock split in 1957. Recently, Amalgamated Bank split 20-for-1 in 2018, and the ad tech business Trade Desk split 10-for-1 in June 2021. Last summer, when Tesla stock was hovering around $1,300, the company's eccentric creator and CEO Elon Musk observed that the shares were too costly IMO, adding that a larger portion of the public should be able to afford the EV darling's shares. This was quickly followed by a 5-for-1 stock split. Fast forward 15 months, and Tesla stock is approaching a comparable level after a stunning rise this year, fueling speculation, which was initiated earlier this month by short seller Gordon Johnson, that Musk may announce another share division to appeal to individual investors. When Tesla announced its 5-for-1 stock split on August 11, 2020, TSLA was at $1,373, said Twitter user Sawyer Merritt. Post-split, we're now back above $1,000 to $1,024. Tesla will probably start to consider another split of some sort as we approach the same $1,300 level. We'll see. The attempt to boost Tesla's free float by cutting its share price, according to Neil McNeil, would temper a crazy market cap that experienced a momentary dip Monday after Musk stated he will sell 10% of his shares, which has made him the world's richest person, for tax purposes. Tesla has awakened the world to the possibility of electric cars, but its valuation doesn't make any sense, said McNeil, whose 30-strong post-split index boasts a 12.5% annualized return since 1996. Tesla, however, is not in it, mainly because of the rich valuation. This company is worth more than any other automobile manufacturer combined, adds McNeil. At nearly 400, its price-to-earnings ratio is 50 times higher than any other competitor. It would have to be in business making a profit for 20 to 30 years to catch up to that kind of valuation. Investors looking to buy Tesla should consider these metrics before engaging in irrational exuberance and buying the stock, warns McNeil. Just last week, New Construct CEO David Traynor added itself to the Tesla bear party, noting the firm would have to sell 31 million cars by 2031 to sustain its current $1.2 trillion valuation. Tesla is worth $150, or 8 times less than its current price tag, Traynor claimed. His target a stark contrast to Jefferies' fresh $1,400 forecast. But David Barse, CEO of ETF investor Xout Capital, disagrees. They, analysts, are using traditional metrics to compare a company like Tesla to the original car manufacturers, and that's just wrong, he says. If you apply a different valuation test and look at Tesla's intangibles like its brand, patents, and goodwill, these are huge and not factored into any of the price predictions. Barse, who says that Tesla is a technology company masquerading as an auto company, says the value of Tesla's data, as collected from its cars to power its autonomous driving software, holds tremendous potential. The future of its data applications could include artificial intelligence, software services, and a myriad of other applications. The market seems to be misanalyzing Tesla. Musk will probably relish the idea of another stock split as he seeks to be a company everyone can invest in, though adding some more shares could also help boost executive compensation. Nevertheless, the split can be a good marketing exercise as investors view the stock as more affordable. This is just a perception, not a reality. But investors are marketed by the concept of buying the shares for a lower amount. Johnson of GLJ Capital said Tesla would very likely split as last year's action helped push the stock higher, and that is really all that Tesla seems to care about. Following last year's division, Tesla shares rallied 12%, and while they dipped this winter, they're now up nearly 70% for the year. I get it now. If TSLA does a 20-to-1 split, GLJ can keep his $67 price target, said Twitter user Gary Black, attempting to describe the rationale behind Johnson's comments. Split or not, Awanda analyst Ed Moya sees Tesla's outlook brightening after announcing deals to sell cars to Hertz and Uber, noting that other global rental firms will likely accelerate such orders. I was wrong when I said $1,000 wasn't going to happen, he notes. Tesla has had a parabolic rise. They've been able to adapt and handle the chip shortage better than the rivals, and while some say the valuation doesn't make any sense, the momentum behind the stock does. A new split will be bullish for the Tesla stock, which Moya sees hitting $2,000. They have a massive retail following, like a cult, so if you have a split, investors will embrace it and the stock will rally. With all this talk about splits, investors should be careful and be on the lookout. Sometimes a stock split can increase market volatility because the new stock price is lower. This means an influx of new investors investing because of the affordability. This can cause the stock's new price to fluctuate widely depending on certain factors, such as investor reactions and price speculation. It's typically an inexperienced investor who mistakenly thinks that the stock split is inherently a good thing. Inexperienced investors tend to confuse correlation with causation. If a company is successful, a stock split is thought to be almost inevitable because book values grow over time, as do dividends usually. If an inexperienced investor witnesses this pattern enough, he or she may inexorably confuse the two terms. There are always exceptions to the rule, like Berkshire Hathaway BRK.B, which has a share price trading in the hundreds of thousands of dollars per share. In May 2020, Musk tweeted that he thought Tesla stock was priced too high, and it immediately fell by $70. To the average person, especially newbie investors, Musk is enigmatic. He has a way of influencing shareholders and potential investors alike with his charismatic approach to just about everything. People tend to do what Musk directs them to do, and in this case, if investors think the stock will split, that's an invitation to buy, and buy they will. How much Tesla, TSLA, will rise after this next split remains to be seen. At its current price, it would have to see around a 30% increase to reap the same benefits as last time around. Tesla could indeed be a great grab if the stock were to split again. Some analysts think that because Tesla was one of the first to go into the market in the EV space, it will continue to reap the vast share of the market, even in the face of fellow competitors. But in coming years, the EV giant will not only have its current rivals, but new upstarts joining the EV race. What will it look like when traditional car makers begin producing electric vehicles too? If Tesla does not split, it's going to keep going up in price in the thousands and potentially tens of thousands of dollars over the coming decade or two. An employee would be priced out of buying Tesla stock if the company does well, and that's no good. Tesla will have to split the stock in order to stop this from happening. Another benefit from splitting the stock is you have more shares in circulation. This allows for a broader number of shares that can be distributed among more employees or other investors. It will be interesting to see if Tesla keeps doing a 5-to-1 stock split or another type of split. A 20-to-1 split may send a message that Tesla is overconfident in its stock growth and price appreciation. A low split may signal a lack of confidence. I think Tesla will continue with a 5-to-1 split, which sends a message of reasonable expectations for the future. We would love to hear your opinion on the Tesla stock split, so please comment down below.